The Rebel Capitalist Show.
I think it's fascinating that I'm just writing this down, they're creating future demand for Bitcoin that doesn't exist. And it's almost identical to Brent's theory for the dollar going to 130 or 140 on the DXY, Brent Johnson.
Okay, I'm not familiar with that. Yeah.
Well, he just talks about the amount of dollar-denominated debt that's outside of the United States, and it's the exact same argument you just made for
Euro
Bitcoin.
Dollars. Absolutely.
How there's just not enough dollars to satisfy the amount of dollar demand, and at some point, because we don't have the velocity, it's going to be time to pay the fiddler, and you're going to see the dollar spike, and that's where kind of the thesis of the premise of the dollar milkshake theory, and it's very similar to what you're saying with the Bitcoin.
Absolutely, the euro dollar market is what I would call it. Yeah, now that you said dollar milkshake theory, I'm familiar with that, and I think they're right. You can be a dollar bear and think that the dollar is not going to survive. Right? Historically, all fiat currencies ultimately fail, and it's just a question of when. And so that's not a controversial statement. But the critical thing to understand is that markets can do this before they do this.
That's right.
And then you can have an unbelievable short squeeze. I think we're going to see an unbelievable short squeeze in Bitcoin. All these Wall Street traders, you look at even some of the most famous people in the Bitcoin world, they're celebrated because they're traders. Look at the background of a lot of these folks that came from Goldman Sachs trading desk or Citadel's trading desk. Okay, so they're thinking that Bitcoin's just another asset class that they can apply their trading strategies to and start piling circulation credit on top of it, start piling paper claims on top of it and trading those paper claims. And they can get away with it for a while. Some have made huge fortunes, some very young folks who haven't experienced a real short squeeze or a real bear market, piling up lots of wealth. But oh boy, just watch because Bitcoin is, as Trace Mayer likes to refer to it, the apex predator of finance. And the reason is because no one's making more than 21 million and individuals control the vast majority of those. There will never be enough supply for Wall Street type of firms to successfully long-term trade this as if it's any other asset, including gold.
There will never be a repo market where Bitcoin is rehypothecated and there's a 30 collateral multiplier on it.
Well, you know what? There is right now. That's the crazy thing. There are people doing exactly that.
But that's the problem.
Well, this is exactly why it's suppressing the Bitcoin price.
Right.
There's a lot more trading volume that comes into that, right? So it's the same argument I've made with the Bitcoin ETF. That is a double-edged sword. You start getting these Wall Street firms that are rehypothecating paper claims to Bitcoin, right? What does that do?
As
Some people think they're buying the real thing. They're not buying the real thing. Only if not your keys, not your coins. If you've got your private keys, then you own the real thing. But there's no question that a number of the coin lending firms are very upfront about it. They rehypothecate Bitcoin.
Yeah.
And so
they're creating artificial supply, additional artificial supply suppressing the price. Yeah. But at some point in time, they're going to need the underlying asset. That's where you get the short squeeze.
That's right. And I think the reason why the gold market historically has never had that short squeeze that a lot of the gold supporters are predicting is coming, and I would agree with them, it is coming. But the reason why they've been able to, for decades, fend it off is because the banks control the underlying. Again, it's the central banks and the LBMA that control the vast majority of gold. And so for them, it's just a question of allocating it through the clearinghouse amongst each other. But that's not true of Bitcoin. I wrote in a recent Forbes piece, there will probably never be a clearinghouse for Bitcoin. And if you're not a Wall Streeter, you're probably scratching your head and wondering, what does that mean? Why does that matter? And it's exactly what I'm talking about. The central banks and the LBMA are a clearinghouse for gold. And so if somebody gets short unexpectedly, they can go to the clearinghouse and get more because the banks collectively control most of the underlying collateral. But that is not the case in Bitcoin. There will probably never be enough in intermediaries to create a clearinghouse like LBMA for gold. And as a result, it's going to be there are going to be some pretty big failures of traditional financial institutions that have to learn that lesson the hard way. And most of them, even the BIS capital guidelines, the Basel III capital guidelines, they came out and proposed that banks that hold Bitcoin, this is banks that are trading it themselves on their balance sheet, are going to have to finance it 1-for-1 with equity. And it's the highest so-called risk weighting for an asset class. And what I said at that time, and this probably shocked a lot of people because I'm a hardcore Bitcoiner, is that's not enough. You saw the banks complaining that it was too high. And I said, no, it's not enough. And the reason is that the capital rules for banks are all very focused on price volatility and not focused on what you and I just talked about for the last several minutes, which is that there's settlement risk. And most of the other assets, really all of the other assets that the big banks trade, have clearinghouses. They can, if they get short, and they need to go get the real collateral to deliver it into their short, they can just go to the clearinghouse and get it from each other. But you can't do that in Bitcoin. That's the difference. And so it really, a fractional reserve bank has no business trading Bitcoin. These crypto assets are truly different animals. And they need to be, to the extent that there are banks like Avanti that touch them, they should be in a straitjacket like the Wyoming digital asset bank rules that say you can't lever, you've got to hold 100% reserves, preferably in cash or T-bills against your customers' deposits. And in Wyoming, at least, we're going to let you keep legal title to the assets by treating it as what's called a bailment under the law. It's very similar to, it's actually the same as a valet parking arrangement for your car or a coat check. You're not handing legal title to your car or your coat over to the garage or the coat check. Rather, you're just handing temporary possession of your property for safekeeping. It's the way the gold money warehouses used to work.
Unlike when you give your dollars to a bank.
Yeah, one of my friends pointed out, when you give your dollars to a bank or your securities to your brokerage firm, using the analogy of valet parking, they take your car, they rent it out to an Uber driver.
No, but they own your car.
All the funds.
They own your car.
You're
in the
absolutely
case
right.
of your dollars. Yeah, they own your car.
And they're making money off your car while they're sticking you with risks you don't even know you have. And then they may give you back your same make and model on demand if you're lucky, but you won't get your actual car back, right? The difference in the way that Wyoming law is applied to Bitcoin for intermediaries like Avanti and there are now 4 Wyoming special purpose depository institutions just for digital assets. And again, not your keys, not your coins. I'm not recommending that people hold digital assets with a custodian, but there are certain types of firms that have to. So that's why we exist. So 40 Act mutual funds, your pension fund, they all have to hold assets in a custodian. And that's why these banks exist, despite the fact that I'm a big believer in not your keys, not your coins. But anyway, the whole idea is you're not giving up legal title to your asset. You're just giving temporary possession. And you get it back when you demand it. And so the whole idea of these special purpose banks is they're set up exactly for this. They're not permitted to rehypothecate. And if you're holding dollar assets, they're backing your dollar assets with 100% cash or T-bills. They're not taking the interest rate or credit risk that we talked about some of the stablecoin issuers are taking. This is important stuff. And I think it's going to be very interesting to see how the market reacts. Would you rather keep your crypto with one of the big banks where when you deposit it, it becomes their asset and they can turn around and make money off it and then maybe give it back to you? And if they can't give it back to you because there's a bank run that happened in the meantime, or it becomes a Lehman-type situation, then you're in line with the creditors and you're going through a bankruptcy for a few years, right? We're seeing that, for example, right now with Cred, one of the crypto lenders, which filed for Chapter 11 in Delaware in December of 2020 or 2019. I can't remember what year, but anyway, so there may be some hard learned lessons. Would you rather hold your Bitcoin in an institution like that, or would you rather hold your Bitcoin in a Wyoming bank that has these special bailment protections? Or more preferably, would you rather teach yourself, make an investment in yourself, in how you securely store your Bitcoin yourself? And make sure that if something, God forbid, happens to you, that someone knows how to find your Bitcoin so they're not lost forever. Those kinds of things are investments in yourself. And I would encourage everyone to make those. Until you really make those, you're not a true Bitcoiner. A lot of folks, I think, are just dipping their toes in for price speculation.
Right.
But once they go down the rabbit hole, you got to really dig in and learn how to securely store your own private keys.